Okay, welcome to the call. We'll get started shortly. Good evening and welcome to the Money Training Call. How's everybody doing this evening? This is Rudy Clay Jr. out of Gary, Indiana. Who do we have on the line with us?
Brother Benny.
Hey, Brother Benny, Gary, Indiana. Welcome. Who else we got on the line with us?
Ken.
Bridget.
Hey, Bridget. How you doing?
I'm
All
hanging
around
in
Georgia.
here. Hanging in here.
Good. Who else we got?
Brother Ken.
I heard two people say that again.
Ken.
Hey, Ken, welcome to the call. You in Memphis, Atlanta?
Yeah, I'm in Memphis till in the morning.
Oh, okay. Welcome to the call, man.
Thank you.
Okay, well, we're going to get this call started. Without further ado, we always start with prayer. Heavenly Father, thank you for bringing us together today. Continue to bless us abundantly. Help those who are in need of your help everywhere around the world. Make this a great training call where it's very easily absorbed and everybody learn a whole lot from it today. In Jesus' name, amen.
Amen.
All right, well, welcome to the call. So we're going to get this call started. And, we were on what page? Today we are starting with time frames and top-down analysis. Okay, and this is really some good stuff. Now, matter of fact, give me a moment. I know they have illustrations, but I do like to have our chart that we used to seeing so for comparisons. So I'll load that up right quick. It's loading pretty slow. Let me see. Yeah. Hmm. Okay, while that's loading, we'll get started. Okay, remove the bar. All right. As a price action trader, your primary time frame is the 1 hour, the 4 hour, and the daily. Then you remember when we were reading it earlier, I said it has to be on these bigger time frames, the way they were talking. So price action traders, their primary, and that's what I started on, the 1 hour. That's the traditional. And price action works on bigger time frames. If you trade pin bars or engulfing bars on the 5 minute time frame, you will lose your money because there's a lot of noise on smaller time frames. That's what makes us so good. And the market will generate a lot of false signals, which we have figured out on that comfort zone because of the hard battle between the bears and the bulls. Besides, there is no successful price action trader who focuses on one time frame to analyze his chart. Maybe you have heard of the term top-down analysis, which means to begin with bigger time frames to get the big picture, and then you switch to the smaller one to decide whether to buy or sell in the market. And that's what we do. You know how we start at the 1 hour chart and then the 30-minute chart, 15-minute chart, and five, and then five. Well, let's say you want to trade the 4 hour chart and you have to look at the weekly chart first and then the daily chart. And if the weekly and the daily chart analysis align with the 4 hour chart, you can then take your trading decision. Hold on one second. Then you can take your trading decision. Oops. And if you want to trade on the 1 hour chart, you have to look at the daily chart first. This is a critical step to do as price action trader because this will help you to avoid low probability trading setups. And it will allow you to stay focused on high probability price action signals. So through our top-down analysis, we always start with a bigger time frame, and we look forward to gather the following information: the most important support and resistance levels. These areas represent turning points in the market. If you can identify them on a weekly chart and you know what is going to happen when the price approaches these levels on the 4 hour chart. So you will decide either to buy or to sell or to ignore the signals you get from the market because you know where the ceiling and the floor is. Second thing is market structure. The weekly analysis will help you identify the market is trending up or down, or is it ranging or a choppy market. In general, you will know what the big investors are doing, and you will try to find a way to follow them on a smaller time frame using my price action strategy. Okay, now the previous candle, that's very good too. The last candle on the weekly chart is important because it tells us what happens during a week, and it provides us with valuable information about the future of the market move, about the future market move. So when you identify these points using the weekly chart, you can now move the daily chart or the 4 hour chart and try to gather information such as the market condition, what is the market doing, what the market is doing at the 4 hour time frame. It is trending up or down. Is it ranging or is it choppy market? Now, what are the most important key levels on the 4 or the daily time frame? This could be support and resistance, supply and demand areas and trend lines. So the price action signal, a candlestick patterns that will provide you with a signal to buy on a short market. This could be a pin bar, an engulfing bar, an inside bar. Let me give you an example to help you understand why it is important to adopt the top-down analysis concept in your trading method. And what is going to happen if you don't look at the bigger time frame before switching to your primary chart? Let's look at the illustration below. Now, this is a weekly time frame. As you can see on the weekly chart above, we have gathered 2 important points that will help us decide what to do on the daily time frame. Now we see these are proven turning points. See, this is like the level of resistance, level of support, like this is the floor. So this is too risky to buy through this level because you see, and you know how we do that, we eye it. So as you can see, the weekly chart above, we have gathered 2 important points that will help us decide what to do on the daily time frame. Now, the first point is that the market approaches, is this the first point? The first point is that the market approaches to an important weekly resistance level. Or is that what they're talking about? I don't know, one of the proven turning point. It must be talking about the first point is that the market approaches to an important weekly resistance level. That must be here. These are resistance. Will represent a high point in the market. Now, the second information is the rejection from this key resistance level. As you can see, price was rejected immediately when it approaches this level. This indicates that the sellers there are sellers there and they are willing to short the market. That means push it down. So every time it goes up to this resistance level, the sellers push it down. Goes up to this resistance level, the sellers push it down. Goes up to this resistance level, it's too risky to buy. Okay? So the second information, rejection from key resistance levels, and as you can see, the price was rejected immediately when it approaches the level and then comes down. What confirms our analysis is the formation of the inside bar false breakout patterns that indicates a reversal. Now let's switch to the daily time frame to see what's going on in the market. See, this is top down. We go to the weekly time frame first and we see those points and then come down to the daily. Now you got more wisdom on this here now. Okay, so now the daily chart, we have a clear pin bar candlestick pattern that indicates a bullish signal. It indicates that this thing might be pushing up. So if you focus on just one time frame to make your trading decision, you will buy the market because there is a clear pin bar signal. But if you analyze the weekly chart, you know that there is a very powerful key level that will stop the market from going up. So it's better to think of selling the market if there's a clear signal rather than to buy it. Look what happened next. See on that daily. And that was definitely a clear looking up trend right there with that pin bar pushing up. But look, now this is what we always look at. We don't look at pin. We look at that doji, boy. That doji always signal something. But as you can see, the top-down analysis worked. The pin bar candlestick signal didn't work because the weekly resistance level was a powerful turning point that reversed the market direction. So if you want to trade price action based on a one-time frame, I highly recommend you to stop trading because you will end up losing your entire trading account, you will never become a successful trader. Okay? Now, trading counter trends is very profitable as well. But without the top down analysis, you will put yourself in troubles. So let me give you another example to show you how you can trade counter trends using your price action trading setups in combination with the top down analysis concept. Now, this is price at major resistance levels, weekly chart, price now an anticipated turning point. The price is now at a level where it is highly anticipated a reversal will occur. How do we know? Because it has been proven a major reversal point in the market if we look to the left. So from here, we only have a clear option. Look for sell signals on our trading time frame. So as you can see in the chart above, price, let me try to get it low. Okay, as you can see in the chart above, price are at a weekly resistance level. Buyers were rejected twice from this level, which indicates that the market is at a hot point and is likely to reverse. Now, what you can do as a price action trader is to switch to the daily time frame to look for a selling opportunity. Now, if you can find price action set up near the weekly resistance level on the daily time frame, this is going to be a high probability setup to take into consideration. See the example below. Now it's a major reversal level derived from the weekly chart. You know, on the weekly, we see these are resistance levels. We wouldn't have saw these resistance level on the daily chart by itself. So we go to a high time frame, seeing some resistance, and you see us do that all the time on the money call. Okay, so we know this is a major resistance level. We had to do that this morning. Remember, we had to switch over to the 30-minute chart or the hour chart and say, oh, yeah, it's near the ceiling, it's near the ceiling. Okay, that's what we were doing. This major, okay, the daily chart above confirms our weekly analysis. As you can see, this is a clear bearish signal near the weekly resistance level. The pin bar was rejected from that level, and there is also the formation of an inside bar false breakout. This is a clear indication of a trend change. Yeah, like a false breakout. Okay, so let's see what happened next. Huge reversal.
Oh my gosh.
Major reversal level. But boy, it looked like it was going up. So the example above shows that counter trend works if it is well mastered in contrarian approach that requires experience. So if you are a beginner, I highly recommend that you stick with the trend. Try to practice as much as you can the top-down analysis concept with the trend. And when you master trading with the trend, you can then move to trade high probability counter trend setups. And you know all counter trends will be retraced. There are many approaches used to time the market turns and plan trades. The most of these approaches lead to greater confusion and lack of confidence in the results. So keeping the analysis simple is the most often the best way to go. And the top-down analysis is one of the easiest approaches that I recommend to master if you want to trade the right way. Now, what you have to do right now is to open your charts and try to practice what you learned in this chapter. Try to identify the market trend using these techniques, and it will be a little confusing at the beginning, no it won't. But with some screen time and practice, you will find it easy to identify the market direction. So let's see if our chart is pulled up yet. That is strange. Usually pops up a lot quicker. Okay, we won't worry about it. I'll quit Firefox and reload it. Oh, my thing is not blinking. Okay, cool. Yeah, see, we had a real good example of that. Was it this morning or yesterday? No, it was this morning when that thing kept going up and it kept going up, and we was looking for where the ceiling was, and we couldn't see the ceiling from the 5 minute, and we went to the 30 minute and hour to see it. So we know how to do it. Now, when we get on the chart, I'll let you guys know it. Okay, the trading strategies and tactics. In the last chapters, you learned three important aspects of price action trading. The first aspect is the market trends. You know how to identify the market trend using multiple time frame analysis. You know how to differentiate between trending markets and range bound markets, and you understand how each market moves. The second aspect is the level. You learned how to draw support and resistance and how to draw trend lines. This skill will help you better enter the market at the right time. And the third aspect is the signals. You have seen different candlestick patterns. You understand the psychology behind this formation and the message they send you. These three aspects, which are the trend, the level, and the signal, are what we would use in our trading approach to make money trading in any financial market. And so, I mean that when you open a chart, you will try to answer three important questions. Number one, what is the market doing? Is it trending, consolidating, or is it a choppy market? Hold on one second. Okay, sorry about that. What the market is doing? Is it trending, consolidating, or is it a choppy market? If it is trending, you know how to identify if it's an uptrend or a downtrend. You know the high lows. If it is a ranging market, you will see that that it is trading horizontally between two boundaries. The ceiling and the floor. And if it's a choppy market, you close your chart and stay away. So what are the most powerful levels in this market? If the market is trending up or down, or it is ranging, you will try to find the most important support and resistance levels. So these levels are the best zones where you can buy and sell the market. Three, what is the best signal to enter the market? The best signal to enter the market means the right time to execute your trade. And this is what you will learn in the next chapter. How to be the best signal and time to execute. Okay, the pin bar candlestick pattern strategy. The pin bar candlestick is one of the most famous Japanese candlesticks. It is widely used by price action traders to determine reversal points in the market. In this section, you will learn in detail how to identify potential pin bar signals and the conditions needed for high probability setups. A pin bar is a chart candlestick. It is characterized by a very long tail that shows rejection and indicates that the market will move in the opposite direction. So the area between the open and the close is called the real body of the candle. Typically, all pin bars have a very small real body and a long shadow, the wick. So a bullish pin bar is known for its lower wick. So it finally said wick. Okay. So a bullish pin bar is known for its lower wicks, and the bearish one is characterized by its long upper wicks. The color of the candlestick is not quite important. However, bullish candles with white real body are more powerful than candles with the real black body. No, man, this thing. Why it had to be more powerful than the black body? Just playing. I know. I ain't gonna play. I'm just playing. But that is something that's a very powerful statement, though. The bullish candles That means candles going up are more powerful than the candles going down. Did you see that? Bullish pin bar with the lower wicks and the upper wicks, color the candlestick. However, bullish candles, that means the candles that are going up are more powerful than the candles with a real black body. So on the other hand, a bearish pin bar with black real bodies are more important than the ones with white real bodies.
Yay.
See how pin bars look, huh?
I said, yay.
Yeah, okay, I got it. The black real bodies are more important. That's right. Black bodies matter, right?
Right.
But here's a bullish pin bar. You see the real body is small and it has a long tail pushing up, you know. That's why they call it bullish. It's pushing up. Whatever direction you see that wick, that's the way it's pushing. Okay, the bearish pin bar, a little small body, that's the real body, and it's pushing down. It has a long tail, so it's a bearish coming down. Now, how to identify pin bar candlestick setups? To be honest, quality price action setups don't exist in the market because you will see that sometimes you can find a high probability setup, you feel very excited about it, and you take your trade with confidence, but at the end, you'll be frustrated because the signal fails for unknown reasons. So that happens a couple of times because the market doesn't move due to a pin bar formation. What moves the market is the law of supply and demand. So let me give you an example. If you identify a quality pin bar candle near a support key level in an uptrend, this is a powerful buying signal to take. You shouldn't ignore it. But if the amount of money that buyers put in this trade is less than the amount of money that sellers risk in the same trade, the market will not go in your predicted direction. So if the signal fails, it doesn't mean that your analysis is wrong or pin bars don't work. It's just because the market didn't validate your decision. Therefore, you accept your drawdown and look for another opportunity. And you may ask yourself, why should we look for quality pin bar setups if the market doesn't respect them? Well, as you know, trading is a game of probabilities. There is no certainty. Psych. This is why you should evaluate your pin bar setups from multiple angles. And the fact that you are looking for quality setups means that you are trying to put the probabilities of success in your favor, which is the right mindset of successful traders. And so it happened this morning. It said, now we know this thing is coming right back down and retrace all those candles. We just didn't know when. Because sometimes now all the setups are there, but, it's still determined by, supply and demand. So to determine whether or not a pin bar is worth trading, this price action signal should respect the following criteria. The pin bar formed in a bigger time frame, such as the 4-hour daily time frame, should be taken into consideration. Because if you look at the smaller time frames, you can easily spot a lot of pin bar signals. These setups should be ignored because the smaller time frames generate a lot of false signals. See illustration below. The pin bar formed in the line with the direction of the market. See that pin bar? Now we clearly see this is an uptrend, right? So this is a pin bar in the daily time frame. The pin bar formed in line with the direction of the market is more powerful than one that is formed against the trend. So if you can identify a clear trend, that means that you know who is in control of the market. So the formation of this candlestick pattern with the trend makes it so effective. See the chart below. Now, You see this pin bar that's pushing up, pin bars with the trend. These pushing up, that's pushing up, and these are pushing down. Push down, they're pushing down, they're pushing down. Well, the most powerful pin bars are the ones that's pushing up. That's basically what they're saying. So we don't necessarily use this style of trading, but it's good to know, okay? As you can see in the chart above, bullish pin bars that were formed in line with the uptrend work, and they should be taken into consideration. But the bearish ones that were formed against the trend should be ignored. The anatomy of a pin bar is importance as well. Let me read that again. The anatomy of a pin bar is important as well. You have to make sure that the candlestick is a pin bar by looking at the distance between the real body and the tail. Pin bars with longer tails are more powerful. The psychology behind the pin bar candle formation. Pin bars are formed when prices are rejected. This rejection doesn't indicate a reversal signal because the price action setup can form everywhere in your chart. Now, the most important areas to watch when trading pin bars are major key levels such as support and resistance, supply and demand zones, and moving averages. So the formation of this candlestick chart pattern and these levels give a clear idea about what happens in the market. Now, if the rejection was near a support level, for example, at the bottom, this is obvious indication that the bulls are more powerful and they are willing to push the market to go upward. See the chart below. Okay. Now this is the support level, the floor. Okay, so if the formation of this candlestick occurs near a resistance level, where is the resistance? I don't understand. We're dealing with the support level. If the rejection was near a support level, for example. Okay, now I guess this is the opposite. If the formation of a candlestick occurs near a resistance level, it must be under here. Yep. Okay, now I got it. So this is the example. This pin bar is toward a floor and it has a long wick pushing up. That's a strong signal that could be an uptrend or reversal, especially when it came up and then pulled back to the support level and then continuation. So the same on the opposite. If the formation of the candlestick occurs near resistance level, it indicates that the bears reject prices and prevent the bulls from breaking this level. So this means that the sellers are willing to push the market downward. See the chart below. Okay. This thing came down, it came up and retested that resistance level, and there was a big old pin bar right there pushing down. That was a high probability that that's coming down. So if you understand the psychology behind the price action pattern formation, you'll be able to predict what is likely to happen in the future, and you will make good trades based on high probability pin bar signals. Now, trading the pin bar candlestick with the trend. If you are a beginner trader, I highly recommend that you stick with the trend because pin bars occur in trending markets, offer good trading opportunities with high risk reward ratio. When you master trading with the trend, you can then move to trade range bound markets and even counter trends. But this strategy is simple. You start by identifying a clear uptrend or downtrend, and you wait for a pin bar to occur after a pullback to support and resistance level. See example below. The figure, so you see the example, this is the resistance level, and this thing came down and the retracement came right up to the resistance level and the pin bar signaled, boom, the push down. And the figure below shows how the price action signal works if it's traded with the trend. As you can see, the price was rejected from the resistance level, which indicates that the bears are still in charge of the downtrend. Now, the formation of the pin bar indicates the end of the retracement move and the beginning of an impulsive move at the resistance level in line with the downtrend. This is a high quality setup because all the following criteria are respected. The pin bar is well formed and it is lined with the direction of the market. The rejection occurred at a major key level, which represents a high point in the market, the resistance level. Number 3, the risk to reward ratio is good and worth trading. Sometimes, even as the market is trending, we can't draw support and resistance lines because prices move in a certain way, which we can't spot static key levels. I mean, being exact. But if you are in this situation, you can use a 21 moving average will act as a dynamic support in the uptrend market and a dynamic resistance in the downtrend market. Wow. See illustration below. Wow. The 21 moving average can act as a support and resistance. The 21 moving average acts as a resistance level all the way down this trend. The pin bar signal in the line with the downtrend, see, it's pushing down. It's confirmation. Okay? So as you can see in the chart above, the market was trending down using the 21 moving average. Helps us to identify dynamic resistance levels with high probability pin bar setup. See another chart. Now here is where the pin bar signal is and the 21 moving average is on the uptrend. So the 4-hour chart above illustrates how the 21 moving average could help us find key points in the market. But when price approaches the moving average, the buying pressure takes place in the market and the price goes up. So the pin bar signal is clear on the chart because the trend is bullish. That means going up. The price action setup has a bullish autonomy as well. And the rejection from the 21 moving average is a confirmation signal to buy in the market. Wow. Did everybody get that? Any questions? Any questions to make sure everybody got that?
Good stuff, sir.
Okay. Hey, welcome to the call, cuz.
Thank you, sir.
Okay, let's go to the trading tactics. When we identify the trend, uptrend or downtrend, and the level, support and resistance, that's it right there. So, and we find a pin bar near these levels in line with the direction of the trend. The second step is to know how to enter the market based on this candlestick pattern. Now, according to my experience, there are different entry options when it comes to trading pin bars. It all depends on the candle anatomy, the market conditions, and your money management strategy. Excuse me. Number 1, the aggressive entry option. This method consists of entering the market immediately after the pin bar closes without waiting for a confirmation. This strategy will help you catch the move from the beginning because sometimes the price goes higher after the close of the pin bar, and if you are not in the market, the trade will leave without you. Wow. So you got to be quicker than that. See example below. See, this is a downtrend market. You got your little stop drawdown up here, and support becomes resistance. See, right now it's support. But once that comes under that and that pin bar came up, then the entry after the close of the pin bar, because you see that pin bar is pushing down hard and it's right under the support level. It broke the support level. So now the support level becomes a ceiling. And then boom, come on down. So sometimes people will just get in quick, is what they're saying. Now, the chart above shows how an aggressive entry could help you execute a trade in the right time without being left by the market. And as you can see, this trade, and as you see, we took this trade because we had three important elements. The trend, the market was trending down. In this case, we look for selling opportunities. You see, it was trending down, okay? A clear pin bar was formed after the retracement back to the resistance level. This came under the support, and then a pin bar, when it was back to the resistance level, a pin bar formed to confirm the continuation down. Now, when we have all these three elements in the market, you just place your trade after the close of the pin bar, and your stop loss above the long tail, and your profit target will be the next support level in case of a downtrend. Now, these three elements are quite enough for you to find high probability entries in the market. Now, the conservative entry option, this strategy consists of entering the market after 50% of the range bar retracement. And this strategy sometimes will work, and it gives you more than a 5-to-1 risk ratio. And sometimes the market will leave without you. See illustration below. Okay, we see this is a downtrend, of course, and this is the resistance level, the ceiling. The ceiling, this is broken under the ceiling. Well, it was a floor back here, but it's broken under, and that pin bar comes all the way up and tests, they say 50% pin bar retracement entry. I don't understand what this green line is. Oh, that's the 50% entry. So let me bridge it. So what this is saying, it comes up to the resistance level, and by the time it retraces halfway, then get in.
Right.
Okay, that's what it looks like. The illustration above gives us an idea about the power of conservative entries. As you can see, this entry method helps us decrease our risk and increase our rewards. The trade above has a more than 5-to-1 risk ratio. One trade like this every month is quite enough to generate a decent income. See another chart below. Now, one of the drawbacks of this entry option is that the market sometimes doesn't retrace 50% of the range bar, which will make you feel frustrated because the market will move to the profit target without you. There's no wrong or right entry option. They both work great, but with screen time and experience, you will be able to decide whether to trade aggressively or conservatively. So this support becomes resistance. This was this support, and then that 50% pin bar, and you stop drawing out. Did everybody get this? Because, see, when they say support becomes resistance, now, see, support is the floor. Resistance is the ceiling. So I don't see the floor. I see the candlesticks below, so it has to be resistance.
When it pulls back.
I got it right here is what they're talking about.
Right,
okay,
right.
Now support becomes resistance. Got it. And 50% retrace.
Okay.
And you get in. Okay. So one of the drawbacks of this entry market sometimes doesn't retrace 50% and the range bar, which will make you feel frustrated. So this came and it didn't come down 50% bin power retracement entry. I'm still not reading this right. Is there something I'm missing here?
Okay, the pin bar comes all the way down. And then it
Uh-huh.
pushes up, pushes up, pushes up. But
50%.
the next candle engulfs the pin bar.
Uh-huh. And it
Okay,
came back down
right.
before
And
it
then
went back.
that hits the support becomes resistance.
Uh-huh. Got it.
So you
And you
know
will be
once you
frustrated
see
because you know this is
bottom,
going straight up and then it comes back down below.
but
Okay.
that's an engulfing candle. And
That's,
when it comes back,
uh-huh.
let me see this, let me look at mine. When it comes back, let me see, when it does that 50%, actually does 100% because it engulfs that whole candle. The next candle is a total engulfing candle.
Sure is.
So we'd have got in at the double bottom anyway.
That's right. That's what we would have
So,
got in. That went straight on up.
and that would have been
Okay.
the floor and the ceiling at the same time
Mm-hmm.
because
Mm-hmm.
it would have created
And
that as the floor.
this strategy, I never really got it. You know, I never really used it. Okay, trading pin bars with confluence, that means everything lining up together. So, and that's when we get into market trend and this and that and all these things together. So confluence happens when many technical indicators generate this. Hold on, there's somebody texting me. I'm sorry. I might be trying to talk and say something and ask a question and I'm not seeing. Oh, okay. Okay, so confluence happens when many technical indicators generate the same signal. This trading concept is used by price action traders to filter their entry points and spot high probability signals in the market. It doesn't matter if you're a beginner or advanced trader, trading with confluence is a must because it will help you focus on quality setups rather than quantity, and it will enhance tremendously your trading performance. Excuse me. Confluence means combination or conjunction. It is a situation in which two or more things join or come together. For example, if we are looking for a pin bar signal, we need to find other factors of confluence to confirm our entry. We are not just going to take any pin bar that we find in our chart, okay? All right, sorry about that. Okay, factors of confluence. The trend. It is not a trend is your friend. Remember that. The trend is your friend. It is one of the most important factors of confluence. This is the first thing that most successful traders look for on their charts. You can't trade any setup without identifying if it is in line with the direction of the market or not. A bearish pin bar and a downtrend is a more powerful signal than one in a range or trend, range-bound market. So support and resistance level and supply and demand areas, these major levels have significant importance in the market because all big participants watch these specific areas. And moving averages, I personally use the 8 and 21 moving average. This technical trading tool acts as a dynamic support and resistance, and it is a very important factor of confluence in trending markets. And also the Fibonacci retracement tool. I use the 61% and 50% Fibonacci retracement to find the most powerful areas in the market. And we'll get into that too. I used to be hot to try. Oh, got to learn that Fibonacci. Okay, trend lines. Drawing these lines on your chart gives us an idea about the market direction and help us find the most important reversal points in the market. So when analyzing your chart, you are obligated to find all these levels to determine whether the trade is valid or not. So if you can find just one or two factors of confluence that come up together with a good pin bar setup, this is quite enough to make a profitable trade. For example, an obvious pin bar signal near the support or resistance level in line with the direction of the market. Let's see the illustration below. Okay, the 21 moving average is acting as a dynamic support level. And this pin bar is at a major support level. See, it's really a resistance level here. It's support everywhere else. And that's a pin bar push, and you see the long tail on the bottom. So what does that mean? That means it's pushing up. And it's in an uptrend. So in the example above, we have a high probability setup with 4 factors of confluence. The trend, we see it's in the trend, okay? And the market is trading up, which means that we have to follow the trend and look for a buying opportunity. Number 2 is the level. The support level is an important key level in the market. As you can see, price broke out of the resistance level. That becomes support and pulled back to it. Okay, so you can see this is the support level. This is the floor. And it came all the way through the floor and pulled back. And here, you can see where it went to the resistance level, came all the way and pulled back. It did break the resistance level and then come down. Now it's a floor. And then go up. So the support level is an important key level in the market. As you can see, price broke out of the resistance level. See, it broke out of the resistance level. Boom, it broke out of the resistance level. And that becomes support and pulled back to it. See, it was resistance, it was the ceiling, and then it pulled back, made it a floor. And then went up. And then number 3, the signal, the formation of the bullish pin bar after the retracement back to the resistance level, that becomes support now. So, and another signal, the rejection of the pin bar from the support level, and the 21 moving average acted as a dynamic support level. So all these factors work together to give us a power trading signal to buy in the market. See, this was like a little, what we call a trend line, so to speak, is support. And it never broke through. It rejected it and kept on up. So that's a powerful example. Let's see another example. Hold on 1 second. I just have to close the blinds. It's getting dark out here. Excuse me 1 second. Okay, now it's getting ready to get into the Fibonacci. The example, the support level, the 50 and 61. But see, it hasn't showed how to use the Fibonacci yet. But it will be coming in a minute. Okay, let's get back to it. Okay, another example. This here is like the floor, and it broke through resistance, then it became a floor, and then went on up. Now this 21 moving average acted as a support level as well. And the 50 and 61 Fibonacci retracement. Now we know how to retrace with our eyeballs at 50%. We do that all the time. The example below shows 4 confluent levels that indicate a powerful trading signal. The first factor is a bullish trend going up. And the second one is the resistance level that becomes support. It was resistance and it broke through and now it's support. It's a floor. Okay, the third one is the 21 moving average that acts as a dynamic support level. And the last factor is a pin bar formation near these levels in line with the bullish trend. So if you adopt this trading concept, you will completely change the way you perceive the market. And you will start trading like a sniper by waiting for the best trading setups to come to you instead of you trying hard to make these trades happen. So let's look at the pin bar trades examples. I will give you some trading examples to help you understand how to trade the pin bar candlestick pattern with the trend and how to use the confluence concept to confirm your entries. Okay, now this is a downtrend market. It's coming down. They got the 21-day moving average. The pin bar is a sales signal. It's pushing down. It's pushing down. And then you got the support that becomes resistance. See, this was the support. It was a support. It broke through support. Now has become the ceiling. Resistance. So this is the New Zealand USD daily chart. As you can see, the market is trending down. This is the first information we gather from this chart. Now, after the breakout of support level that becomes resistance, the floor becomes the ceiling, the price retraced back to this level and formed a pin bar candle pattern. Now, the formation of the pin bar near the resistance level indicates that the retracement move is over and the beginning of an impulsive move is likely to happen. So when we put the 21 moving average and the Fibonacci retracement on the chart, we see that the pin bar is rejected from these levels, which indicates that this level is very important and sellers are willing to push the market lower. Here, in this example, we have solid reasons to sell the market. The first reason is the downtrend. The second reason is the formation of the pin bar near the resistance level, which indicates the end of a pullback and the beginning of the new move downward. And the third reason is the rejection of the pin bar from the resistance level and the 21 moving average. And the last reason is the pin bar rejection from the 50% Fibonacci retracement level, which is considered to be one of the most powerful key levels in the market. And look at this chart below to see what happened next. Okay, we see this is a floor, the support, and it came and broke through the support level and then came back up, and now this resistance, it tested the ceiling level. It's a ceiling now, and went straight back down. And that pin bar was the signal. We see the long wick pushing down after it broke through support and came back up and retested support, which is a ceiling now with a pin bar pushing down. Boom, that's a downtrend. So as you can see in the chart above, our analysis was right because was based on solid reasons to enter the market. This is the method that I want you to learn and be able to trade the market successfully. Look at another chart below. Okay. And basically what it's saying, when you get into key resistance or support levels with pin bars, they usually signal some kind of a movement in the market in the direction of the pin bar. Now, the chart above shows two important buying opportunities. The market was trending up. That's the first thing we see in any chart. We look at the overall trend, and it was trending up. The formation of the first pin bar after the retracement back to the support level was a high probability entry. Okay, so what they're saying is when these candlesticks, they were trending up, and then this first pin bar after the retracement back, see, it went up to the ceiling and came back down to support, and now that long pin bar is pushing up. See the wick? So it's a retracement back to the support level was a high probability entry. So what confirms our entry is the rejection from the 21 moving average. See, it didn't break that green line and the 50% Fibonacci level. But we haven't learned how to do the Fibonacci. Well, that hasn't come up yet. And there's I'll go over that with people. We don't use it, we eye it, but it's good to know. The same thing happens with the second pin bar that allowed us to enter the market again with more profits. See, it came up and it broke the resistance, which became support, and then it was rejected and pushed. Wait a minute, I'm sorry. Yeah, it broke the resistance, which is the ceiling, and came back to retest it's a floor now. See, I'm looking at all these dojis too. See, that could be a little confusing for a new person. But this is the pin bar with a long push up, even though it broke back below the support. But that push up, that was the signal. Over here was the signal I would have been looking at myself as well. So the chart above shows two important buying opportunities. The market was trending up. The formation of the first pin bar after the retracement back to the support level was a high probability entry. And what confirms our entry is the rejection of the 21 moving average and the 50% Fibonacci retracement. The same thing happens with the second pin bar that allowed us to enter the market again and make more profits. So trading pin bars in a range-bound market, this is where I say we just be scalping. You can only scalp. We can say that a market is ranging when prices don't make any higher and higher lows and start trading horizontally between a definable level of support and a definable level of resistance. So once I see that the market changes its behavior, I have to change my tactics and adopt a trading strategy that fits the new market condition. So to confirm a ranging market, I have to look for at least 2 touches of the support level and 2 touches of the resistance level. And once I have identified the range, then it becomes very simple to trade it by going long, or long means going by. Just by so it's very simple to trade by going on a buy when prices reaches the support level and going on a sell when prices approach the resistance level. See the example below. And that's what we talk about. We don't have as many candles on our candles, see, this is like on a daily, so it's a lot of candles. But we see this on shorter time frames, and they say, okay, it's just scalping. Just go up to the top, down to the bottom, up to the top, down to the floor ceiling, floor ceiling, floor ceiling. You heard me say that. Well, this is the range-bound market. As you can see, as prices approach the key support and resistance levels, we have an opportunity to buy or sell the market, and we need just to wait for a clear price action setup, such as a pin bar or a candlestick, see, to kind of give you or a double bottom. See that double bottom? See that pin bar, double bottom, pin bar? See, they always, look at that illustration below. Okay, this is the resistance level, the ceiling, and this is the support level, the floor. Okay, so this is the buy zone, the pin bar signal, see, and it's pushing upward anyway. It hit that level of support, buy. Pin bar, hit that level of support in that zone, and it's pushing up, buy. Hit that level of support, pin bar pushing up, buy. So the illustration above shows us 3 trading opportunities. Let me explain to you how you can trade them successfully. The first one is a pin bar rejected from the support level. Right there. You can place a buy order after the pin bar closes, or you can wait for the market to touch the 50% of the pin bar range. Your stop drawdown should be placed above the support level and your profit target must be placed near the resistance level, near the ceiling. The risk reward of this trade is very attractive. The second trading opportunity occurs near, they're talking about this one. The second trading opportunity occurs near the support level. You place a buy order after the close of the pin bar, and your stop drawdown should be below the support level. And that means below this level. And your profit target is the next resistance level up here. Once you know it's a range market, you know what a ceiling is. The third setup is obvious buying opportunity, as you can see. Now, this is the third one here. Okay. As you can see, the market was rejected from support level and formed a pin bar to inform us that buyers are still there and the market is likely to bounce from the support level. Now, trading from major key support and resistance levels is the easiest way to make money trading range-bound markets. Never try to trade any setup if it is not strongly rejected from these areas. The second strategy is about trading in the direction of the breakouts of major key levels, or waiting for the price to retrace back to the breakout point, and then you go buy or you sell the market. So there it is. This is a buy going, and then it's a sell and a buy for a sell and for, So and then it breaks out, but it retests with a pin bar. Oh yeah, that's continuation. Okay. All right. The figure above illustrates a range-bound market. The price broke out of the support level and retraces back to the point of the breakout, and the formation of an obvious pin bar indicates a high probability signal to sell the market. So this is how professional traders trade ranging markets based on this price action signal. Now, how to confirm pin bar signals using technical indicators. Using technical indicators, and once we finish this chapter, we'll close out. Now, using technical indicators to confirm your entries will increase your probability of the trade being profitable. I'm not telling you that you have to focus on indicators to generate signals, because this will never work for you. But if you can combine your price action strategies with the right indicators, you will be able to filter your signals to trade the best setups. And that's what we do using the RSI and the EMA. So one of the best indicators that I use to confirm my entries when I examine a range-bound market is the Bollinger Bands indicator, not the Bollinger Bands. Don't nobody else know about the Bollinger Bands yet. Okay. Bridget, I know she knows. But this technical trading tool was developed by John Bollinger to measure market's volatility. And so the strategy is very simple. We'll combine horizontal support and resistance with the upper and lower Bollinger Bands false breakout. Now, if prices are rejected from major key levels and from the bands, this is a confirmation that the market will bounce from these levels. See an example below. See these blue lines? Those are called the Bollinger Bands. Okay. So if you look at the chart above, you will notice how the Bollinger Bands act as dynamic support and resistance. When the market approaches the upper or lower bands, prices bounce strongly. And you can see that. They never break through. They kind of bounce. They start bound. That's kind of bounce, come on down. That's, and here's a rejected pin bar and all that. So if we see that a pin bar is rejected from a horizontal key level and from bands, this is a clear confirmation to buy or sell in the market. This confirmation strategy is very simple, and it will help you decide whether to take a trade or ignore it, because trading is all about emotions, and sometimes you will spot a nice pin bar signal in a range-bound market, but you will find it difficult to make a decision. So what you have to do in this case is simple. Just put your Bollinger Bands on your chart. And if you see that the signal is rejected from horizontal levels and the bands, don't overthinking about what you should do next. Just execute your trade, place your stop drawdown and profit target, then stay away and let the market do the work for you. See, they talking about longer time frames though. See another illustration. The daily chart. The daily chart shows us how the indicator could help us execute our trades with confidence. The false breakout of the resistance level that was made by the pin bar was a powerful signal to sell the market. So, you know, it came up, it's all at a resistance level, and it's at the Bollinger Band resistance. So that's a powerful signal to put in a sell. Okay, the false breakout to the resistance level that was made by the pin bar was a powerful signal to sell the market. The trade was confirmed by the false breakout of the upper band as well. I don't know what false breakout on the Bollinger Band mean, but I know the false breakout on the EMA is going to above the EMA and it's not going above the 60. We know how, you know, to deal with them fake outs as well. So remember that this technical indicator is used just as a confirmation tool in a range-bound markets. Don't use it to generate signals. Use it always in combination with horizontal key levels, and you will see how this strategy will affect positively your trading account. Now, in conclusion, I recommend you to practice these strategies as much as you can before you open and fund your trading account, okay? And then tomorrow we'll be going into the engulfing bar candlesticks, okay?
Sir.
Any questions? I tell you, that only thing that it didn't do was show how to use the Fibonacci and how to use the, you know, kind of explain the Bollinger Bands a little more. So you probably have to learn that on your own. But we don't use all those. We know how. We just use just a EMA and RSI, and but we know how to read these candlesticks and win anyway. So tomorrow we'll be going over this, and the next money call is in the morning at 8 a.m. Eastern, 7 a.m. Central, and 5 a.m. Pacific Standard Time, where we'll be getting those tips. And I tell you, I want to thank God for God, and I want to thank all of you for being on this call and staying focused on this exciting journey. And right at closing, I want to show you the chart on just quickly closing with this. Okay, now just click on the chart. It will, there's your Bollinger Bands. You see the Bollinger Bands? See, that's the Bollinger Band. See how I respected that band, just broke out and came back down. So we don't use all these indicators, but you can, you know, study that on your own in your back office and all that, okay? So you guys have a great evening. I want to thank God for God. Thank all of you for staying focused. We're going to have this call in the morning. We're going to be getting those tips in the morning. And matter of fact, was anybody not on the call this morning? It was a real nice little uptrend. So you guys have a great evening, and we'll talk soon, okay?
All right, no, thanks.
Thank you.
All right, and thank you all. Take care. Thank you, Bridget.
You're welcome. Thank you.
Thank you.
All right.
Bless team.
Okay.
All right, peaceful team. Be peaceful.
All right.
Take care.
Good night.